So multinational operations, only 4 points. Just 4 points and we're done. These are going to be relatively chunkier, but they're fun. Number one, we will work on FX transaction. Very simple. Will be through in 10 minutes, maybe 5 minutes. Very easy to deal with. The number two, we will deal with FX translation. Translation. This will take some time because this is where we will have to learn current method. This is where we will have to learn temporal method. Then number three, we will deal with the hyperinflationary environment. There is some environment, there is some US GAAP, IFRS controversy there, especially IFRS has been a little controversial in the accounting world. So we'll discuss a little bit about that. This is where I will discuss this really cool thing called phenomena that some of the companies were experiencing, which is called disappearing property, plant and equipment. Like from their balance sheets, property, plant and equipment were disappearing and companies were complaining about that. That was happening under IFRS. I'll show you why that was happening. And then finally, we will do this discussion on net exposure and then some analytical implications. Okay, just these 4 sections and we should be through. Let us do FX transaction. Now this particular reading, curriculum is written extremely poorly. So my recommendation to you is either you use the main videos if you have access to them, or you use some other reading material or other videos. The curriculum does not do justice to this topic. Let us start. We will start FX transaction. Very simple. It's not a fun time. It's something else. It will come. Be patient. I think I'll try to wrap up quick now. What is FX transaction? FX transaction is simply, in a very simple language, some sort of an export or import transaction. You're not buying you don't have a foreign subsidiary yet. That will come in FX translation. You just buying something or selling something, that is creating, and you're buying something and selling something on credit. So it might create a temporary asset, right? How do you deal with that? Very simple. Record sales or cost at transaction day FX rate. Whatever is the foreign currency rate on the date of transaction, record. If balance sheet date falls between transaction date and payment date, then change value of AR and or AP based on balance sheet FX rate, balance sheet closing day FX rate. Third, when transaction is settled, by the way, this will create some gain or loss. It will be unrecognized, unrealized. It will be recognized, but it is unrealized. This goes to income statement. Okay, I'll show you an example. It's easy. When transaction is settled, then use FX rate of that day to close. Again, will create gain or losses. That will also go to income statement, but this time those will be realized gains or losses. Okay, for example, let us assume on 15th of December, okay, you sold some goods. Who are you, by the way? Let's say this is an Indian company. You sold goods to a US customer at $100. Right? You're an Indian company, you sold goods to US customer $100. Then the payment was received on 10th of January. In between, we had a balance sheet date. Exchange rate were as follows. Date, FX rate. So first date, 15th of December, let's say rate was rupees 80 for a dollar. Then 31st of December, let's assume dollar appreciated, we have 90 for a dollar. And let's assume we close the transaction on 10th of January. Of 10th of January, dollar appreciated again a little bit, so $95. Okay. Now, based on that, how will I do accounting? So very simple. Here's your accounting on 15th of December. This is your balance sheet. This is your income statement. You will say sales $100 into what is the rate on the date of transaction? 80. So sales will be how much? 8,000. Second effect, and this is 8,000 rupees. Okay. Second effect, accounts receivable 8,000 rupees. That's it. So on the date of transaction, whatever is the exchange rate. Now 31st of December. 31st of December, you will say accounts receivable. Now the exchange rate has become 90. So you will make accounts receivable as 9,000 because your accounts receivable was $100 at the rate of 80, but transaction is not closed yet, and now the exchange rate has become 90. Is that a gain? Yes. So income statement, FX, look at the word transaction gain, not translation gain. It's a transaction. So FX transaction gain, how much? 1,000. Okay. Then 15th of, sorry, when were we closing? 10th of January. 10th of January, your accounts receivable opening is 9,000. Cash received, so accounts receivable you will close, it will become 0 because those guys are paying you. But cash received will be 9,500. So 9,500 cash is added. So my balance sheet asset side, which is called debit, increased by 500, right? So I will go to income statement. I will create one more FX gain. FX transaction gain 500. What is the difference between the two? This gain at the time of recording was unrealized, but now obviously this gain is realized. In fact, I've realized the whole 1,500 as gain now, but accounting is that simple. This is how you do accounting for the FX transactions. Have you understood this? Yes. Now, my question to you is this operating or non-operating item? That means, is this above EBIT or below EBIT? If you answer this, I'll be super. It's not OCI, it's an income statement. Why are you saying OCI? I've recorded that in income statement. My question to you is this FX gain in both the cases operating or non-operating? If it's operating, it's above EBIT. If it's non-operating, it's below EBIT. How many of you? Come on, I want each one of you to answer, operating or non-operating. Right. This is a matter of controversy in the accounting world. Both IFRS and US GAAP do not specify whether it should be operating or non-operating. Now, why is this? Why does this matter you? If they don't specify, good, one less thing to remember. However, when comparing companies, right? Let's say you're comparing something like a EBIT margin, operating profit margin, then you need to be careful because quite possible that one company has taken this gain and put that above EBIT, other companies taken that gain and put below EBIT. Operating margins are not comparable, so you need to be super careful with that. Understood? Second, also be mindful that FX gains or losses reported on income statement may include both realized as well as unrealized gains and losses. Do you agree? We just saw that in example. In one case, it was realized. In one case, it was unrealized. So as an analyst, you again need to be careful because quite possible the unrealized gain might disappear if the currency depreciates in the next quarter. Is that okay? So just simple analytical treatments, and I think this section is over for us. That's it. Okay, here, comfortable? All right. Are you guys with me? Have you understood? Have you understood this? Okay. All right. So time for me to take you to the section number 2. Section 2 now on the FX translation. FX translation basically means, in simple language, you have, thank you for pointing that out. And please focus on what, focus on the session, not Ankit on the chat box pointed out my Mac was kind of losing battery. If you have a foreign subsidiary, then those foreign subsidiary, when you want to convert to your domestic currency, then that's where you need to be using this translation mechanism. Now, there are two methods proposed. Which two methods? Current and temporal. Now, can you tell me these current method and temporal method, is this the name used or nomenclature used in US GAAP or IFRS? Or is it both? Word current method and temporal method, is this the nomenclature used in US GAAP or IFRS? Or both? Okay, the answer is none. And both US GAAP and IFRS do not use the word current method or temporal method. They describe the method. The accounting world calls them as current and temporal. But the US GAAP and IFRS does not use the word that use current method or temporal method, right? This is just normal and it doesn't matter for the exam, just a fun fact to know. Okay. Now, to decide which method is to use when, we need to learn about three currencies. There is called as a presentation currency. Then there is a functional currency. And then there is a local currency. Tell me, what is a local currency? This is straightforward currency of the subsidiary wherever they are operating. So if I'm a US parent, I have Indian subsidiary, Indian rupee is a local currency. What is the presentation currency? It's parent's currency, right? The dispute is with respect to what is functional currency. So functional currency is the currency of primary economic environment. Okay. Now, both IFRS and US GAAP have a 6-7 point list that helps companies determine what their functional currency is, like some sort of a guideline. And it's up to the company to decide what is their functional currency. The management will decide that this is my functional currency. Your functional currency could either be same as the currency of the parent, or your functional currency could be the same as currency of your subsidiary, or it could be altogether, in theory, a different currency. Okay, but in most of the cases, this functional currency is either same as local currency, or functional currency is either same as parent's currency. Depending on that, your accounting method changes. Now, what do you mean by primary economic environment? So very simple, straightforward. There is a 7-8 point list, but generally, how do you determine your sales price is critical. Are you determining your sales price based on the pricing that you use? For example, Apple phones in India. Are they being priced based on what is the price set by the Apple in the US? Or are they being priced differently for Indian environment? Is Indian environment determining the price differently, right? Depending, once you answer that question, then automatically your functional currency is determined. For example, you say that, hey, we decide price in US dollar first, we just convert that to rupees and put that price in Indian rupee. That means my sales price is a function of US dollar price, then US dollar is a functional currency. But no, we have an India specific pricing. We determine the price for Indian market, then my functional currency is Indian rupee. Is that okay? So primary economic environment, if you just know this much, is good enough. Now the idea is, if you have a situation where, let's say presentation currency, let's say your parent is in US, okay, this is a parent company, and subsidiary is in India, all right, and Indian rupee is a local currency. Now you might have a situation where Indian rupee is also happens to be the functional currency. Is that possible? That the currency of the subsidiary local currency is same as functional currency. If this is the case, can I say that I'm using my own language here, it's kind of a autonomous subsidiary, or let's call it as a strong subsidiary. They are taking decisions all by themselves, right? If this is the case where local currency is same as functional currency, you're translating functional currency to presentation currency. Then the method that we use in this situation is the current method. But imagine an environment where the parent is in the US, that's their presentation currency. Okay, the subsidiary is in India, so Indian rupee is the local currency. However, the presentation currency also happens to be functional currency. That means the boss sitting in the US is taking all the calls, right? All the decision making is happening in US itself. So now, can I call this as this is my language, by the way, can I call this some sort of a weak subsidiary, the one that does not have a lot of autonomy? So when you're translating financial statement from local to functional, is that correct? Local to functional? Then the method that you want to use is the temporal method. That's roughly and this is true for both US GAAP and IFRS. So let's think about it. When do we use what type of method? If I am translating from presentation currency, functional currency, local currency, let's say I have to convert from local currency to functional currency. Okay, then which method? Temporal method. And if I'm converting from functional currency to presentation currency, then I will use a current method. This is how you can think of a weak subsidiary. Okay, my language, not curriculum. This is how you can think that this is a strong subsidiary, because functional currency is same as local currency. Up to this, are we okay? Yes, no? Yes, all right. Then how do you do the conversion? So here's how you do the conversion. I'm building like one big table for you. This is there in the juice notes, so kind of repeating that, but it will be fun to do it. Current method. This is my balance sheet. This is my income statement. Under current method, all items on the income statement, all items are converted at, come on, help me out, at average cost. All items here on the asset side at current cost. Okay. Then all debt item at current cost. Equity at historical cost. Let me just say historical cost. Then retained earnings. Retained earnings, is it given? It should be opening, which is given, plus profit of this year, which has come at average cost. Opening is given in rupee terms, but profit of this year will come at average cost. And finally, how will I make my balance sheet tally? So that plug figure, which is called CTA, here the plug figure is put in as a part of equity. So remember, the plug figure under this method is called cumulative translation adjustment. It's a part of equity. This is your current method summary. Easy? Then Under temporal method, on balance sheet asset side, we divide all the assets into two parts: monetary, non-monetary. What are monetary assets? Which are fixed in terms of number of units of currency you will receive. Number of units of currency you will receive. That's the definition of monetary. What do you mean by that? Something as simple as cash. If someone owes me $100, if I have $100, I will get $100. Accounts receivable, monetary asset. Any other asset you can think of which is monetary? Something which is fixed, right? Bond investment, monetary asset. Okay, so fixed in terms of number of units. If it's a monetary asset, which rate do we use? Krishna, monetary asset, which rate? Akshay, current rate. Huh? Current rate. If it's a non-monetary asset, which means some asset where value can fluctuate in simple language, which is like PPE, inventory, and all of those, which rate? Historical. What do you mean by historical? The actual transaction date rate. Okay. Here, liabilities. Let's say I have some debt. I have some accounts payable. Most of the liabilities. What type of liabilities are these? These are typically, most of the liabilities will be monetary liabilities, fixed in amount of currency. If it's a monetary liability, what rate? Current rate. Okay. Then equity, what rate? Come on, equity, historical rate. Then retained earnings, given, given, plus opening is given, plus we have to do some jugaad here. I don't know what's the English word for jugaad. I think jugaad is the English word now. It is. They've added that to that dictionary. I don't know what. This is this year's profit, by the way. Okay, this year's profit, which I'm calling as jugaad, but it's not like a simple profit. We have to do some gimmicky thing to reach that number. Okay, I'll show you. We'll do an example, and that's it. Is there a CTA here? No. Income statement. Sales. Which rate? Sales, average rate. COGS, historical rate. SG&A, average rate. Depreciation on PP, historical. So you just need to remember this inventory related and depreciation related will go in at historical rate, and that's how I will get my net profit. Okay. However, see, this is the profit and this is my jugaad profit. So in fact, right now, let's just call it profit. Okay, so I will call it profit, some XYZ number. But this is not my final profit. To that, I need to do some FX gain or loss. I have to add some number. Then I will get my final profit. Let's call it as jugaad profit. Right, so this is where I'm doing that as a plug figure. This is where I get that number, and this number goes in here so that my balance sheet tallies. So the idea is you need to reverse calculate your FX gains and losses in such a way that when you transfer the current year profit to retained earning, that balance sheet tallies. This is how we do temporal method. Okay, let's do an example. One example, we should be done with it. All right, here we go. You are absorbing, right? Okay, we'll get to know now. All right, this is the balance sheet of the subsidiary. I'm creating an exam level example for you. So let's say this is in subsidiary balance sheet, subsidiary income statement. This is in US dollar. Okay, so subsidiary is in US dollar, parent is in Indian rupee. So the calculations are easier, right? Now, equity here is $500. Retained earnings $1,000. Debt, another $1,000. PPE, $1,000. Inventory, this is $2,500 by the way. This is also $2,500. Inventory, $500. Accounts receivable, $500. Cash, $500. Income statement, sales during the year, $1,000. COGS, $400. GP, $600. SG and A, $100. Depreciation, $100. Your profit before tax, this is $400. Taxes, $100. Net profit, $300. Is this $300 already included in this 1,000? Yes. When I prepare a balance sheet of year one and income statement of year one, how will my balance sheet tally if I had already not transferred it? It's already transferred. This is end, balance sheet is anyways end of the year, no? So when you look at annual report of listed companies, do you again take this year's profit and add to their balance sheet? No, because it's already there, right? So keep that in mind. This 300 is included in that 1,000. That means opening equity in US, opening return earning in US dollar must have been 700. This year profit made 300. That's how the balance sheet tallied. All the second effect of these transactions already reflected on the balance sheet. Okay. Let me now start throwing this exchange rate and some important information to you. Opening value of retained earning in INR for both the methods, they're generally not same, but for simplicity, for both the methods is 60,000 rupees. Okay, so let's just call it INR so that we distinguish between rupee and dollar. Opening return earning in INR, 60,000. Then historical rate for equity, PP and inventory. I'm keeping the same rate here. They can be different historical rate for equity, can be different historical rate for inventory. Let us say that was when we started the company, 50 rupees for a dollar. 50 rupees for a dollar. Then the average rate during the year was rupees 70 for a dollar. What is happening to currency, foreign currency? Appreciating. Subsidiaries currency is appreciating. Good for us, right? Mostly good for us, not always. That part we'll discuss later. Average here, then current rate, that means closing rate, end of the year rate, rupees 90 for a dollar. Now, based on this information, I want you to prepare income statement and balance sheet under current method and under temporal method. You do this, big part of this reading is over for us. 70-80% done. Current rate means closing rate. Current आप करोगे, temporal मैं करूँ? नहीं, दोनों आप करोगे. All right, let's do it together. Should we? Are you guys done? Should we do this together now? Let's do the current method first because it's so easy to do. Let's start with current. Okay. Under current method, I will first take this income statement here and everything in the income statement under current method, everything on the income statement is converted at what rate? Average. So if I were to multiply everything with average, I would simply get net profit as 300 into 70. So that's 21, Satvik Equis, 21,000 INR. How many of you got this part right? High pass. Easy, right? This stuff is easy, like just everything at flat rate, average, end of the story. Let's do the balance sheet now. Okay, let's convert the balance sheet under current method. So now this PPE, we will convert PPE under current method at what rate? Current rate. Inventory at current rate. Accounts receivable, current rate. Cash, current rate. So you know what? We're converting the whole of the asset side at current rate. Everything at current rate. So net I will be left with 2500 into 90. That's how much? 225,000 INR. 225,000. That's the total of the balance sheet. So total is kind of frozen. On the debt side, what rate? Current rate. So this will be 1000 into 90. So this becomes INR 90,000. Equity at what rate? Historical rate. So 500 into 50, 500 into 50, 25,000. Retained earnings, opening value was 60,000. Now, how is this opening value calculated? Imagine retained earning means years of accumulated profit, and every year my profit was calculated at average rate. So if I've done business of 10 years, opening retained earnings is a weighted average of the average rate of last 10 years. You know, because every year it's average and it's amount related. So weighted average of average. So which means all practical purpose, this is given to you. Now to opening retained earning, I will add this year's, what went something wrong here? Opening retained earnings, 60,000 plus profit for the year. Profit for the year is 21,000. So 21,000. So this value is becoming 81,000. Okay. Now, in order to make the balance sheet tally, I need to throw in that CTA number in such a way that even here the total is 225,000. That's it. So how will I calculate that? 225 minus 90 minus 81 minus 25. How much is that CTA number? 29,000. So we've had a gain here. Done. Profit will be at. Profit is included in RE in the US dollar terms, but in rupee terms, I'd given you opening RE. That will always be the case, no? Because how do you know what is the closing RE till the time you don't know what is the INR profit this year? But I can take last year's translated financial statement, take opening RE, this year's profit in INR after translation, add that to opening RE. How many of you got CTA number right here? Can you give me a I pass on the box, or at least you feel confident that you can do this? Okay, that's great. If you're getting this, that's fantastic. Sarvesh, Shala, Bhavika, good job. And I'm glad you're still participating in the class. I'm proud of you people for pushing yourself. I know it can get a little tiring, right? Today's the intense session. Temporal. All right, let's do the income statement piece first because there's a lot of moving pieces here. This is our income statement. Now, sales. First, write down the rates. At what rate? Average. Average rate क्या है? 70. Okay. COGS. Historical. What rate? 50. Then SG&A. Average. What rate? 70. Depreciation. Historical. What rate? 50. And taxes. Average. Average is 70 again. So let's do the math. 70,000, 20,000. GP became 50,000. Then this will be 7,000, 5,000. So 12 38, 38,000, 7,000, 31,000. This is in INR. Good. That's impressive. Is this the final profit? No. This is my profit before FX gains, right? And then I will have FX gains. I don't know what that number is. And then I will have closing profit. Because under temporal method, FX gains are put into income statement. Now let's do temporal balance sheet here. And by the way, do I know what this number is right now? I don't, right? For that, we need to go to balance sheet. So let's go to balance sheet now. So here we go. PP, what rate? Historical, that's 50. Inventory, historical, 50. AR. AR is what type of asset? Monetary asset. So we use current rate, which is 90. Cash, current rate, which is 90. Debt, current rate, because monetary asset at 90. Retained earnings, opening plus this equity, historical rate, which is 50. So let's at least do the asset side first. So this is 50,000, this is 25,000, this is 45,000, this is 45,000. Now worth एक 40 एक 65 165. So 165. This is total on this side. This is 90,000. This is 50,000. Yeah, 25,000. Yeah, sorry, my mistake. This is 25,000. We're reaching to the end. Come on, be alert. 25,000. Opening retained earnings. Opening is given as 60,000. Now the thing is, plus profit for the year. This is my plug figure in such a way that the total on this side is 165. Are you understanding the logic? So that my balance sheet tallies. So total here is 165. Now this is 85 and 90, 175, which means my profit for this year has to be minus 10,000, which is my net profit. Then only my balance sheet will tally. Correct? Which means on your income statement, this number should be minus 10. So generally we do income statement first, then we do balance sheet. But here, because we need to reverse calculate that number, the sequence is from here to here. We first calculate this, then we go here. That's the sequence. Now the idea is I already have 31,000 type of profit, but I need to convert that to 10,000 of loss. So then the next step is to go from here to here. What is my FX gain or what is my FX loss? So now we have to create a FX loss of 41,000. So I create a FX loss of 41,000. Then it gives me a closing profit of minus 10,000. Then it comes here and then only balance sheet tallies. This is how temporal method works. Now, how many of you got this part right? Super impressive, you did. That's fantastic. Then I think you've got grip of this concept. Then you're more or less sorted. Suman, can you do this now if required? Aisha, temporal method is making P&L. Yeah, I agree. I mean, obviously the whole subsidiaries, asset and loss. Like, imagine you have a foreign subsidiary, you have a lot of assets and liability. Every year, because of that foreign currency fluctuation, you will have to bring that on your P&L. It will make it very volatile. That's true. Okay. All right. So now current and temporal is out of the way. Let me just quickly refer to my notes. Let me make sure I've covered everything. Yeah, we have my section number 3. I told you total 4 section. Main section is over. Let's go to section number 3 here. Section number 3 is what to do if we end up in a hyperinflationary environment. What to do if we end up in a hyperinflationary environment? Then how do we do accounting? So first, what is hyperinflation? If cumulative 3 years of inflation is 100% or more, then it's hyperinflation. That roughly turns out to 26% per annum type of number. If you're in a hyperinflation, then US GAAP and IFRS use 2 separate parts. IFRS says, okay, if you're in hyperinflation, then restate certain assets. Restate means what? Restate means just increase the value of the asset so that you're capturing that inflation in the value of asset, and then use current method. So change the value of the asset, then use current method. Companies don't like it. Okay, so this accounting method is hated by companies, and very soon I will show you why. And why is it headed? Because at the beginning of the session, I told you that this creates something called as a disappearing plant or PPE problem. Okay, I'll explain very soon what that means. US GAAP actually uses a better approach, which US companies appreciate, and the rest of the world companies hope that someday IFRS uses US GAAP. This is rare cases where apparently US GAAP is using a smarter method. US GAAP says don't do this nonsense, just use temporal. Inflation is automatically taken care of. And it is actually automatically taken care of under temporal method. Okay, now why? Let's look at first what is IFRS dilemma and what is that disappearing plant problem. So let's think of IFRS. Okay, here's how you want to think. Let us say I'm an Indian company. Okay? I have a subsidiary in US. Indian parent, subsidiary in the US. Now, 1st January 2000, let us say I invest $1,000 into the subsidiary. In fact, not $1,000. I invested, let us say, 50,000 rupees in the subsidiary. That time the exchange rate was rupees 50 for a dollar. Therefore, the value became how much? $1,000. Now, subsidiary bought PPE of $1,000. Now, subsequently, US is experiencing, it will be a weird day if that happens. US is experiencing hyperinflation. Since it's an example and I'm a teacher, I can do whatever I want. So now US is in hyperinflation. Now see what happens. Let's say this is year 1, year 2, year 3. The PP carrying value in US dollars is 1,000. Correct? Now this year, inflation rate is, let us say 40%. So what you do is, you would say adjusted or restated value. Restated carrying value under IFRS will become $1,400. You just take the inflation, bump it up. Do you understand this? Now the FX rate. Now you guys have learned interest rate parity. So you know that if US is experiencing a 40% inflation, then US currency should depreciate by 40%. You know? So if I depreciate this precisely by 40%, could be, I think how much, if I reduce this by 40%, this should be how much? 30, you know? So if I make this as, let's say 30 for rupees 30 for a dollar, then what is the now PPE in INR terms? That means when I convert to parent currency, when I convert this to parent company, I'm going to multiply with 30, no? So how much will that be? 42. So ये थोड़ा 30 के ऊपर होना चाहिए. So let's make this as, can you do, कितना amount लगाया था हमने? 50,000 divided by 1400, 35.71. So if this is 35.71 for a dollar, when I'll convert this, it will become rupees 50,000. Is it same as the value that I initially invested? Yes. So by this logic, IFRS should work well. But what was experienced in the market is that when country gets into hyperinflation, currency actually depreciates much more rapidly. So instead of this rate becoming 35, there is a possibility that this 35.71 actually becomes only rupees 30 for a dollar. If it becomes 30 for a dollar, your asset value is how much? 1400 into 30, how much is that? 42,000. So in rupee terms, that property, plant and equipment on your books now would be shown at 42. Fair enough. Next year now, we will say opening value in dollar terms 1400. This year we had inflation of 30%. Okay, so let's readjust the value. 1400 into 1.3, 1820. Now, ideally, dollar should depreciate by 30%, but let's depreciate dollar even more. So let's make this dollar as rupees 15 for a dollar. So now in rupee terms, that plant will be how much? 27,300. Now next year in dollar terms, this is 1820. Let's take a 25% inflation. So let's restate the value, 1820 into 25%. So in dollar terms, that asset has become 2275. But now the exchange rate has become, I'm just making up something random now, rupees 5 for a dollar. So it will be how much? 11,375. So imagine now you're an analyst sitting in India and you're looking at this consolidated balance sheet of this company, and you know that this company has a plant in US. First year when you'll see the value, you will be like 42,000. But next year you would see the value, you will be like, oh, maybe it's a depreciation, 27,300. But next year you would see the value 11, and if this happens one more year, very soon the value will get closer to 0. So low that now it doesn't make sense to report it separately, just club it into something. Your plant just disappeared from the balance sheet, but the plant is still there. That is your disappearing plant problem. This happens under IFRS if the currency depreciates faster than the inflation that we are experiencing. US GAAP says don't do this nonsense. We have already figured out temporary and monetary and non-monetary. Monetary assets are the ones which are hurt by inflation. So by using the current rate, which is depreciated, you are reducing their value. If you have a property, plant and equipment, it is not hurt by inflation. Think about it. If you have a PPE, high inflation, no problem, asset value is higher. So therefore, just use the historical rate. Under temporal method, PPE views historical rate. So under temporal method, my asset will always remain at 50,000 rupees in Indian rupee terms under temporal method. That's why US GAAP has a superior method than IFRS here. Did you understand this part? Okay. Last piece of it is the balance sheet exposure and analytical issues. Analytical issues, especially from the ratio perspective, because there will be a lot of questions which will require you to do comparison of ratio of current versus temporal, before conversion versus after conversion type of ratios. Okay, first balance sheet exposure. For that, let's build some background. Who is this? No, this is an Indian. What is this? This is US. And what is this? No, this is a USD asset. Okay. Now this Indian owns USD asset. Now the way you want to think about this is, when I own a USD asset, then the way you want to think is, I will benefit, Indian will benefit if the USD appreciates. So it's a very fundamental concept. If I have a US dollar asset, then to an Indian, it's a benefit if rupee depreciates and US dollar appreciates. So whatever currency I have asset in, that currency needs to appreciate. It's a loss if USD depreciates. This is true for an asset. But what if I have a USD liability? Okay. Then if I have a liability, then I have a benefit if that foreign currency depreciates. And I have a loss if that foreign currency appreciates. So this is your fundamental building block of being able to answer these questions. If I have an asset, I want that foreign currency to appreciate. If I have a liability, I want that foreign currency to depreciate. Is this okay? Are you with me on this? If you've understood this, then let's think of exposure. Exposure to what? Exposure to current rate. Current rate means the closing rate. Under current method on my balance sheet, all assets are translated at what rate? Current rate. Then outsiders, all liabilities are translated at what rate? Current rate. Can I say these assets, all assets, will generally be more than outsiders liability? Correct? That means I will have net assets which are translated at current rate. That means generally under current method, you will have a positive exposure. That means you have some sort of a asset here, a positive exposure, like an asset. So then in this situation, you will benefit if the foreign currency appreciates, and you will have a loss when foreign currency depreciates. Look at my previous example here. Okay, we use the current method and we use the temporal method. What is happening to foreign currency here was dollar. What was happening to dollar? Foreign currency was appreciating, right? Current rate was going higher, and under current method I have net asset. I have asset, currency appreciating. Should that be a profit or loss? Profit. So look at the CTA number, it was a positive number. We will have a profit. Make sense? Now, under temporal method, on the balance sheet, I will have non-monetary assets. Non-monetary assets are what? PPE and inventory, mostly. These are converted at what rate? Historical rate, correct? Then I will have monetary assets. Monetary assets are converted at what? What are the monetary assets? Cash and accounts receivable. These are converted at what rate? Current rate. So this is my exposure, current rate. Here my exposure was all. Okay. Here I will have all outsiders liabilities like debt or maybe accounts payable. All the debt, this is converted at what rate? Current rate. This is at current rate, and equity is at historical rate. Now what happens under temporal is opposite of what happens under current, because you use only current assets on assets current rate. So generally monetary assets will be less than all the monetary liabilities. Why? Because all liabilities are current. Yes or no? So that means my liabilities are more, assets are less. So my net exposure is negative here under temporal method, because we are using only monetary assets as current rate, whereas I'm using all the liabilities at current rate. So net exposure negative. That means it's like a liability. That means it's like this. So here I will benefit if the foreign currency depreciates, but I will have a loss if the foreign currency appreciates. In our example, foreign currency was appreciating because see how rupee was moving from 50 to 70 to 90. Foreign currency was appreciating. Under temporal method, we actually booked a loss of 41,000. Right? So you need to be mindful of this concept. Number one, if I have an asset, currency appreciates, profit. Liability, currency depreciates, profit. Asset, currency depreciates, loss. Liability, currency appreciates, loss. Under current method, I have a net asset because my exposure is positive. Because all the assets current rate, outsiders liability current rate. So my net exposure is equal to value of equity, which is all the assets minus outsiders liability, which is a positive exposure. So under current method, if the foreign currency subsidiary appreciates, profit, depreciates, loss. But under temporal method, only monetary assets at current, non-monetary at Historical. And generally monetary assets will be what? Cash and AR. But non-monetary liabilities will be, sorry, monetary liabilities will be debt, AP, everything. So liabilities will be more at current, converted at current, right? More liabilities, less assets. So therefore net exposure negative, like a liability. So if the foreign currency appreciates, loss, depreciates, profit. And this is subject to the assumption that the exposure is positive or negative. In rare circumstances, you might have a situation where under current method, the exposure is negative. When does that happen? When equity has become negative. That means company is accumulating losses for years and years. Then equation gets inverted. Under temporal method, the exposure can become positive when you have a very large value of monetary asset and you have no liability on the books. So these are general guidelines, but you need to be a thinking mind, right? And based on that, you should be able to answer. And that's it. And then finally, we have ratios, for which I have a very simple trick for you. I know most of you are tired, but I'll still write it down. You will have two types of question. You will have before translation ratios versus after translation. Now, after translation, again, we'll have two scenarios: translation using temp method, translation using current method. In these type of questions, which are easy to answer, these are the questions. Let's calculate them. Two types of ratio calculations. These are one. These are very easy to answer because all that you need to do is you need to plot numerator and denominator, and you need to ask yourself numerator at what rate. Let's say rate X, right? Depending on, let's say it's a maybe a gross profit margin ratio, temporal method, sales minus COGS. COGS is at historical rate. If historical rate was lower, COGS is lower, so GP is higher. So at what rate did I convert numerator? At what rate did I convert denominator? Versus original ratio. If you converted numerator at a higher rate, then your ratio is higher, correct? But if you converted numerator at a lower rate, ratio is lower. So if you have first category of question, which is before translation versus after translation, either temporal or current, it's an easy question to answer. If on the day of exam, you end up meeting a very vicious, cruel question writer. If I had to write a mock exam for you, where I want to really make your life difficult, what I'll do is I will put 6 case study on this topic, because people who are solving from the end or solving from the beginning, right? I'll put this case study in the middle where your fatigue is highest. And here's what I'll do. The second type of ratio calculation is after translation versus after translation. In one case, current method, in one case, temporal method, and now decide which ratio is higher. So here what you need to do now, which gets very complex, is this numerator, this denominator, this numerator, this denominator. If you are converting at rate x1 and if you are converting at rate x2, then you need to check which one is higher, x1 or x2. Let us say x2 is higher, then here numerator is higher. If I tell you that x2 is higher, then if you're converting this at y1 and this at y2, then which one is higher? Okay, let's say luckily for you, this turned out to be lower. Then conclusive, temporal ratio is higher. But what if this also turned out to be higher? Then the answer is inconclusive. So this situation, you can end up getting 3 scenarios: higher ratio, lower ratio, inconclusive. These are low likely questions. I have not come across many. Category 2 of ratios, mostly you're looking at this one, after translation versus before translation. Just see the impact on numerator, denominator, compare them with each other. You just need to compare x versus y and you're sorted. Here your comparison is x1 versus x2, y1 versus y2. You understood this? session for today is over.